Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe, Simple Sound. Today, we're diving deep into the often intimidating world of market risk. This episode is based on an insightful article titled Understanding Market Risk, which provides a comprehensive overview of the different types of market risks, how to measure them, and most importantly, how to manage them. It really emphasizes the crucial role diversification plays and highlights the common mistakes investors make, like trying to time the market, something we'll definitely be discussing. The article's key takeaways stress that market risk is unavoidable but manageable, and that understanding your own time horizon and risk tolerance is paramount. To illustrate these points, we've crafted some engaging scenarios that will help you apply these concepts to real-world situations. We'll cover four main topics today. First, we'll tackle understanding equity risk, where we'll explore scenarios like tech bubble 2.0 and long-term growth versus short-term volatility to see how market downturns and corrections can impact your investments. Next, we'll move on to navigating interest rate risk. Get ready to analyze the impact of rising rates on your bond portfolio and the attractiveness of high dividend stocks. Our third topic focuses on managing diversification and rebalancing. We'll debunk the myth of over-diversification and discuss the importance of rebalancing after a bull market run. Finally, we'll wrap things up with inflation and currency risks. We'll delve into scenarios involving unexpected inflation and a strengthening US dollar and discuss how these factors can impact your portfolio and what strategies you can use to mitigate those risks. So, grab your favorite beverage, settle in, and get ready to demystify market risk with Safe, Simple Sound. Let's start by diving into a hypothetical scenario we're calling Tech Bubble 2.0. Imagine the tech sector experiences rapid, almost unbelievable growth, followed by a sudden and sharp downturn, much like the dot-com bubble of the late 90s. Taylor, if you were heavily invested in tech stocks during such an event, what impact do you think that would have on your portfolio?
Well, a downturn in a specific sector like tech, especially one I'm heavily invested in, would probably mean a significant drop in my portfolio's value, right? It's kind of scary to think about.
Exactly. And that brings us to our first key question for Sam. What are some warning signs of a potential bubble, particularly in a specific sector?
Great question, Alex. One clear sign is an extreme disconnect between company valuations and their underlying fundamentals, like earnings or revenue. Think sky-high stock prices with little to justify them. Another is excessive hype and media attention, creating a fear of missing out FOMO that drives speculative investment, not sound financial decisions. Finally, a rapid influx of new, untested companies into the market can be another indicator.
So, if I'm seeing news articles constantly hyping up a new technology and stock prices are soaring, even though the companies haven't really proven themselves, that could be a red flag. In other words, high volatility isn't necessarily risky in itself, but it can be a symptom of other underlying risks.
Precisely, Taylor. That's a sharp observation. The article on safesimplesound.com highlighted how volatility can be a sign of underlying risk. Now, Sam, let's move to our second question. How can someone diversify their portfolio to mitigate the impact of a sector-specific downturn, like the hypothetical tech bubble 2.0?
Diversification is your best defense against sector-specific risks. Think of it like this. If you put all your eggs in one basket, say the tech basket, and that basket falls, you lose everything. But if you spread your eggs across different baskets, tech, healthcare, financials, real estate, even international markets, the fall of one basket won't be catastrophic. Remember, as mentioned earlier, diversification isn't just about different sectors. It's also about different asset classes like stocks, bonds, and even commodities.
So, if I understand correctly, even if I believe strongly in the future of technology, it would be unwise to invest solely in that sector. Instead, I should spread my investments across a variety of sectors and asset classes to lessen the impact if one area performs poorly. Does that sound right?
Absolutely, Taylor. You've grasped the core concept of diversification. It's about balancing risk and reward.
And to add to that, Taylor, diversification also ties into beta. A portfolio with a beta of 1 moves in line with the overall market. If you are heavily concentrated in a volatile sector like tech, your portfolio's beta could be significantly higher than 1, amplifying the market's movements. Diversification helps manage that beta and smooth out the ride.
Let's recap the key takeaways. First, we talked about warning signs of potential bubbles, extreme valuations, media hype, and a flood of new companies. Second, we emphasized the importance of diversification across sectors and asset classes to mitigate the impact of a sector-specific downturn. For our listeners, we have a call to action. Take some time to evaluate your current portfolio's sector allocation. Are you overly concentrated in any one area? If so, consider diversifying into other sectors. Remember, a well-diversified portfolio is a key component of a sound financial strategy. Let's next tackle a common investor dilemma: long-term growth versus short-term volatility. Imagine a company with strong fundamentals, consistent earnings, a solid balance sheet, and promising growth prospects, suddenly experiences a temporary stock price drop due to a market correction, not company-specific news. You're a long-term investor. Do you hold, buy more, or sell? Taylor, what's your initial gut reaction?
Ooh, tough one. My gut says panic, especially if I see my portfolio balance shrinking. My first instinct might be to sell and cut my losses before things get worse. But we talked about market timing being a bad idea in the previous episode, right?
Exactly right. And Sam, what's the perspective from a more seasoned investor's standpoint?
Taylor's initial reaction is completely understandable. It's human nature to avoid losses. However, as a long-term investor, you need to differentiate between price and value. A market correction often creates a disconnect between the two. A stock price can decline temporarily due to broader market sentiment, while the underlying value of the company remains intact. This is where fundamental analysis becomes crucial.
That's a great point, Sam. Remember, as we discussed earlier, fundamental analysis helps us assess the intrinsic value of a company based on its financial health and performance. So, Taylor, connecting this back to Alex's first question, how does your investment time horizon play into this?
Okay, so if I'm investing for the long term, say 10 plus years, short-term fluctuations shouldn't scare me as much. It's normal for the market to go up and down. If the company's fundamentals haven't changed, then theoretically the price should recover over time, perhaps even exceed its previous high.
Precisely. The longer your time horizon, the more time you have to recover from these dips and benefit from the long-term growth potential of the market. Let's say you're saving for retirement 20 years out. A market correction might even present a buying opportunity, allowing you to purchase more shares of fundamentally strong companies at a discounted price. This aligns with the concept of dollar cost averaging. Sam, could you give us an example of this playing out in the real world?
Sure. Consider the 2020 market crash triggered by the pandemic. Many excellent companies saw their stock prices plummet, even though their businesses were fundamentally sound. Investors who panicked and sold locked in those losses, but those who held on, or even bought more, saw significant gains when the market recovered, often exceeding pre-crash levels within a year or two.
So, if I understand correctly, if I've done my homework and believe in the company's long-term prospects, a temporary dip, even a significant one, isn't necessarily a reason to sell. It could even be a chance to buy more. This feels counterintuitive, but it makes logical sense.
Exactly. And that counterintuitive aspect is why understanding these principles is so vital. Remember what we discussed earlier about managing market risk. Diversification and a long-term perspective are your best defenses against volatility. To quickly recap, long-term investors should prioritize fundamental analysis and resist the urge to react emotionally to short-term market swings. Volatility is a normal part of the market cycle, and for long-term investors, it can even present opportunities. As a call to action for our listeners, take some time to review your current investment strategy. Does it align with your time horizon and risk tolerance? If not, consider adjusting your approach based on what we've discussed. Next, let's dive into a specific scenario: rising rates and their impact on bond values. Imagine the Federal Reserve announces a series of interest rate hikes. You're holding a portfolio of bonds. What happens next? Sam, Taylor, let's unpack this.
Sounds a little nerve-wracking, to be honest. I remember from our earlier discussion that interest rates and bond prices move in opposite directions, but I'm still a bit fuzzy on why that is.
Excellent question, Taylor. That's our first key question to address. What is the inverse relationship between bond prices and interest rates? Sam, could you shed some light on this?
Certainly. Think of it like this. A bond is essentially a loan you make to a government or company. It pays a fixed interest rate, often called the coupon rate. If prevailing interest rates rise after you purchase your bond, new bonds issued will offer higher coupon rates. Suddenly, your bond with its lower rate looks less attractive to investors. To make it competitive, the market price of your existing bond will fall. Conversely, if rates fall, your bond, with its relatively higher coupon rate, becomes more valuable and its price rises.
So, if I understand correctly, it's like shopping for a used car. If a newer model comes out with better features for the same price, the value of the older model goes down.
That's a great analogy, Taylor. Sam, could you build on that with a simple example?
Let's say you own a bond paying 3% interest. If interest rates rise and new bonds offer 4%, your 3% bond becomes less desirable. To attract buyers, the price of your bond will fall until its effective yield, considering the lower purchase price, is closer to the prevailing 4% rate.
Exactly. Investors always seek the best return for their money.
Right, this makes sense now. So our second question is, how can you protect your bond portfolio in a rising rate environment? Knowing that bond prices drop when rates rise is one thing, but what can we actually do about it?
There are several strategies. One is to shorten the duration of your bond holdings. Shorter-term bonds are less sensitive to interest rate changes. You could also consider bond laddering, which involves holding bonds with staggered maturity dates. As shorter-term bonds mature, you can reinvest the proceeds in newer bonds with higher interest rates.
Diversification within your bond portfolio can also help mitigate interest rate risk.
That makes sense. So diversifying within bonds themselves, as well as diversifying between stocks, bonds, and other assets. It's all about not putting all your eggs in one basket. This also reminds me of the part of the article that mentioned dollar cost averaging. Could that be helpful here too?
Absolutely. Dollar cost averaging is a great strategy, especially when interest rates are fluctuating. By spreading your bond purchases over time, you reduce the risk of buying all your bonds just before a large interest rate hike.
Let's recap our key takeaways. First, bond prices and interest rates have an inverse relationship. When rates rise, bond prices fall, and vice versa. Second, several strategies can help manage interest rate risk, including shortening bond duration, laddering bonds, and diversifying.
And importantly, remembering that volatility, like short-term price fluctuations, doesn't necessarily equal risk for the long-term investor.
Exactly right, Taylor. For our listeners, a call to action. Research different types of bonds. Consider strategies like laddering or holding shorter-term bonds. And if needed, consult with a financial advisor to develop a strategy that aligns with your specific financial goals and risk tolerance. We're continuing our discussion on navigating interest rate risk, and now we're focusing on how rising interest rates impact high-dividend stocks. Remember, these are stocks known for paying out a larger portion of their profits as dividends to shareholders. The scenario we're exploring is one where interest rates climb significantly, suddenly making fixed-income investments like bonds more appealing. So Sam, why might high-dividend stocks become less attractive when interest rates go up?
Well, Alex, it boils down to competition for investor dollars. When interest rates rise, the yields on fixed income securities like bonds also rise. This offers investors a guaranteed return, albeit sometimes a modest one, that becomes increasingly competitive with the dividend yields of stocks. Suddenly, a seemingly safe 4% yield from a reliable bond looks a lot more tempting than a potentially variable 4% dividend yield from a stock especially when that stock price could fluctuate.
So if I understand correctly, it's like comparing a bird in the hand with two in the bush. The bond's yield is the bird in the hand, a sure thing, while the stock's dividend, although potentially higher, carries more risk. Is that right?
Exactly, Taylor. And the higher interest rates rise, the more attractive that bird in the hand becomes. Investors might start selling off their dividend stocks to lock in those safer returns from bonds, driving down the price of the stocks.
That's a great analogy, Taylor. As mentioned in the article about market risk, bonds typically have lower volatility than stocks. So during times of rising interest rates, investors may prefer the relative safety of bonds. Sam, how should investors evaluate dividend-paying stocks in this kind of environment?
Investors need to analyze the fundamentals of the underlying company. Is the dividend sustainable? Is the company's earnings growth strong enough to support future dividend increases, or is it struggling? A high dividend yield can sometimes be a red flag, indicating a struggling company where the high yield is the only thing attracting investors.
This reminds me of what we discussed about value traps in episode 33. Companies that look cheap but are actually facing fundamental problems. A high dividend might mask these problems for a little while, but ultimately the stock price could suffer.
Precisely. A high dividend yield alone isn't enough. It's crucial to examine the company's financial health and its future prospects. Now, Sam, can you give us a real-world example of how this might play out?
Let's say Company A is a utility company with a stable 4% dividend yield. If interest rates on 10-year government bonds rise to 5%, investors might see the bonds as a safer and more attractive option, especially if they believe Company A's growth prospects are limited. This could lead to selling pressure on Company A's stock, even if the company is fundamentally sound. Conversely, if Company B, a tech company, has a 2% dividend yield but strong growth potential, investors might still favor its stock over a 5% bond yield, anticipating higher future earnings and potential stock price appreciation.
So if I'm following, the key takeaway here isn't to automatically dump all dividend-paying stocks when interest rates rise. It's about reevaluating your holdings, considering the company's fundamentals, future prospects, and comparing the dividend yield to what's available in the fixed income market.
Excellent summary, Taylor. That's exactly the point. As interest rates change, it's vital to analyze the fundamentals of your dividend-paying stocks and compare their yields to current fixed income options. Consider the potential for growth and the overall risk profile of your portfolio. Now we're going to tackle a common misconception, the idea that more diversification is always better. Our scenario involves an investor who owns hundreds of different stocks and ETFs, thinking they're perfectly diversified. Are they really? Let's dive in with our expert Sam and our learner Taylor. Sam, is there such a thing as too much diversification?
Absolutely, Alex. While diversification is crucial for managing risk, like the equity risk and inflation risk we talked about earlier, there's a point of diminishing returns. Having too many investments or over-diversification can actually work against you.
So if I understand correctly, spreading your investments across different asset classes is good, but spreading them too thin might be a problem. How does that work? This reminds me of when we discussed putting all your eggs in one basket. Diversification helps prevent that, but are you saying there's such a thing as having too many baskets?
That's a great analogy, Taylor. Sam, can you elaborate on how over-diversification can negatively impact returns?
Sure. Let's start simple. Imagine you own just two stocks. One performs exceptionally well, the other poorly. The strong performer can significantly boost your overall return. Now picture owning 100 stocks. Even if one stock doubles in value, its impact on your total portfolio is diluted. The more stocks you own, the closer your returns will mirror the overall market average.
So you're saying that with excessive diversification, your portfolio essentially becomes an expensive index fund?
Precisely. And remember those higher costs mentioned in the article about too much diversification? Those management fees, transaction costs, and even the time it takes to manage such a large portfolio all eat into your returns. You're working harder, potentially paying more, but your returns might not be any better and could even be worse than a simple low-cost index fund. Let's take a more complex example. Imagine you add a highly specialized, potentially high-growth biotech stock to a diversified portfolio of 100 stocks. Its impact is minimal, but in a smaller, more focused portfolio, that same biotech stock's success could make a significant difference.
Let's pause here for a quick recap. Too much diversification can dilute the impact of high-performing investments and increase costs, leading to returns that mirror the market average or even underperform it. Taylor, does that make sense?
Yes, it does. It's almost counterintuitive. I always thought spreading your money as widely as possible was the safest approach, but I see now how it can become less effective and more costly.
It's a common misconception. A counterexample to this is Warren Buffett. He advocates for concentrated investments in high-conviction companies rather than extreme diversification. He argues that true diversification comes from deep understanding of the businesses you invest in, not simply owning hundreds of different stocks.
That's an excellent point, Sam. So, Taylor, thinking practically, how could someone identify if their portfolio is over-diversified?
Well, based on what we discussed, I'd look for a portfolio with a very large number of holdings, especially if many of them overlap in terms of sector or geography. And I'd also consider whether the complexity of managing the portfolio is worth the potential return. It sounds like it's crucial to understand not just what you own, but why you own it.
Exactly. So let's wrap this up. We learned that while diversification is important, over-diversification can dilute returns and increase costs. A well-diversified portfolio doesn't need hundreds of holdings. It needs a strategic mix of assets aligned with your goals and risk tolerance. Our call to action for you today: take a look at your own portfolio. Are you over-diversified? Consider consolidating your holdings, reducing costs and complexity. In the next segment, we'll be discussing how to strategically rebalance your portfolio to maintain your desired asset allocation and risk level. Welcome back to Safe, Simple, Sound. We're continuing our discussion on diversification and rebalancing, and today we're tackling a specific scenario: rebalancing after a bull market. Imagine your portfolio has been performing exceptionally well, and the stock portion has grown significantly, now exceeding your target allocation. This is a great problem to have, but it requires action. Sam and Taylor, what are your initial thoughts?
It sounds like a good problem, like you said, Alex, but I'm curious why it requires action. If stocks are doing so well, why wouldn't I just ride the wave?
That's a great question, Taylor, and a common one. It speaks to the very purpose of rebalancing. Sam, could you shed some light on this?
The purpose of rebalancing is to maintain your desired level of risk. When stocks outperform other asset classes, like bonds, your portfolio becomes more heavily weighted towards stocks, increasing your overall risk exposure. Rebalancing involves selling some of your winning investments, in this case stocks, and buying more of the underperforming assets to bring your portfolio back to its original target allocation. This essentially forces you to sell high and buy low, a core principle of successful investing.
So, if I understand correctly, Sam, rebalancing isn't about chasing returns. It's about managing risk. Even if stocks are doing well, exceeding our target allocation means we're taking on more risk than we initially intended.
That makes sense. This reminds me of what we talked about in the previous episode regarding market risk and volatility. Even though a bull market feels good, increased volatility means greater potential for losses, right?
Exactly, Taylor. Now, the next logical question is, how do we determine our target asset allocation, and when should we rebalance? Sam?
Determining your target asset allocation is a very personal decision. It depends on factors like your time horizon, risk tolerance, and financial goals. Someone saving for retirement decades away can generally tolerate more risk and thus a higher allocation to stocks than someone nearing retirement. As for when to rebalance, there are various approaches. Some investors rebalance at set intervals like quarterly or annually. Others rebalance when their portfolio drifts a certain percentage away from their target allocations, say 5% or 10%. The article on safesimplesound.com highlights these strategies.
So there's no one-size-fits-all answer. It's about finding what aligns with your individual circumstances.
This makes me think of a practical example. Let's say my target allocation is 70% stocks and 30% bonds. After a bull market, my portfolio shifts to 80% stocks and 20% bonds. Rebalancing would mean selling 10% of my stocks and buying 10% more bonds to return to my 70-30 target, right?
Precisely. And think about it, Taylor. You're selling stocks when they're potentially overvalued and buying bonds that might be relatively undervalued. You're taking profits and strategically repositioning your portfolio.
Let's pause here for a quick recap. Rebalancing is about risk management, not chasing returns. We determine our target asset allocation based on our personal circumstances and rebalance at set intervals or when our portfolio deviates significantly from our target.
So, if I'm a long-term investor and comfortable with market fluctuations, I might rebalance less frequently, maybe annually. But if I'm closer to retirement and have a lower risk tolerance, I might choose a more frequent schedule, like quarterly. Is that correct?
Exactly, Taylor. That shows a strong understanding. The key is to have a plan and stick to it, removing emotion from the equation. Don't be tempted to chase returns during a bull market or panic sell during a downturn. The article highlights some common risk management mistakes, such as trying to time the market.
This has been incredibly insightful. To wrap up, let's remember the key takeaways. Rebalancing helps maintain your desired risk level by strategically adjusting your portfolio back to your target allocations. It forces disciplined investing by encouraging you to sell high and buy low.
It's all about keeping your investment strategy aligned with your goals and risk tolerance, regardless of market conditions.
Absolutely. As a call to action for our listeners, establish a rebalancing schedule and stick to it. This disciplined approach is crucial for long-term investment success. Now we're diving into a tricky scenario, the inflationary surprise. Imagine inflation unexpectedly spikes, eroding the purchasing power of your savings. Suddenly, that dollar in your pocket doesn't buy what it used to. Taylor, as our learner today, how are you feeling about this prospect?
Honestly, Alex, it's a bit unsettling. We talked earlier about how inflation is like a silent thief, but this surprise scenario feels more like a robbery. It makes me wonder, how does inflation actually impact different kinds of investments? Like, does it hit stocks and bonds the same way?
That's a great question to kick us off. Sam, can you shed some light on how inflation affects various asset classes?
Certainly. Inflation's impact varies widely. Think of cash and traditional bonds. Their fixed returns lose value when prices rise. If your bond pays 3% but inflation is 4%, you're losing 1% of your purchasing power each year. Stocks are a bit more nuanced. Some companies can pass rising costs on to consumers, maintaining profitability during inflationary periods. Others struggle, especially those with high debt burdens.
So, if I understand correctly, bonds are generally more vulnerable to inflation than stocks. This reminds me of what we discussed about interest rate risk. Are they related?
Yes, they are connected. Rising inflation often leads central banks to increase interest rates to cool down the economy. As we learned earlier, rising interest rates generally cause bond prices to fall. So bonds can get hit by a double whammy during inflationary periods.
Let's use a real-world example. Imagine you buy a bond for $1,000 that pays 5% interest annually. If inflation rises to 6%, your $50 interest payment is effectively worth less because goods and services now cost more. Your $1,000 principal also loses value over time because it will buy fewer goods and services when you eventually redeem the bond.
Okay, that makes sense. But what about protecting ourselves from this inflation? What investment strategies can help?
Several strategies can help hedge against inflation. Commodities, for example, often rise in price alongside inflation. Think of oil, gold, or agricultural products. Real estate also tends to hold its value during inflationary times, and rents can increase, providing a hedge. Finally, there are inflation-protected securities, like TIPS, Treasury Inflation-Protected Securities, where the principal adjusts with inflation.
To recap Sam's point, when inflation heats up, consider assets that can keep pace. Commodities, real estate, and TIPS offer some potential protection, although each has its own risks. For example, commodity prices can be volatile, and real estate isn't always liquid.
So diversifying across these asset classes could be a good strategy, right? Instead of putting all my eggs in one basket, I could spread them across stocks, bonds, some commodities, maybe even consider real estate if my situation allows.
Precisely, diversification is key. It's not about eliminating risk entirely, but about managing it strategically. A well-diversified portfolio can cushion the blow from unexpected inflation.
Excellent point, Sam. So, to wrap up this segment, inflation can significantly impact your investments, affecting different asset classes in unique ways. To manage this risk, consider diversifying your portfolio with assets that historically perform well during inflationary periods, such as commodities, real estate, and inflation-protected securities like TIPS. We'll talk more about diversification strategies in future episodes, but for now, I encourage you to research these inflation hedging assets further. Our final scenario for this episode is titled The Strong Dollar Dilemma. Imagine the US dollar strengthens significantly against other currencies. How does this impact returns from international investments for US-based investors? Sam, Taylor, let's unpack this. Taylor, from our previous discussions, can you remind us what currency risk is and how it affects international investments?
Sure, Alex. Currency risk, as I understand it, is the risk that the exchange rate between the currency you're investing in and your home currency will move unfavorably. So, if I invest in a Japanese company and the yen weakens against the dollar, even if the company's stock price goes up in yen, my return in dollars could be lower or even negative when I convert it back. This reminds me of the example in the article we discussed earlier about how a strong dollar can reduce returns from international investments.
Exactly right, Taylor. It's like buying something on sale in another country, but then finding out that the exchange rate made it more expensive than buying it at home. Sam, can you build on this and explain how a strong dollar specifically impacts returns?
Absolutely. Let's say you invest $100 in a European company when the exchange rate is 1 to 1 yuan. Your investment buys you €100 worth of stock. Now suppose the company's stock price stays flat but the dollar strengthens to $1 for 120. When you convert your €100 back to dollars, you only get $83.33. You haven't lost anything in euros, but you've lost value in dollars due to the currency fluctuation.
So, if I understand correctly, even if the underlying investment performs well, a strong dollar can eat into my returns or even create a loss. What if the stock price actually increased in euros? Would a strong dollar still lessen the gains?
Yes, it would lessen the gains. Suppose the European company's stock price increased by 10%, so your €100 investment is now worth €110. With the exchange rate at $1 to 120, that 110 translates to roughly $91.67. You've made a gain, but the strong dollar has reduced it compared to if the exchange rate had remained at $1 to 1.
That's a great point, Sam. It's a subtle but important distinction. Currency fluctuations can both reduce gains and amplify losses. Now, the million-dollar question: how do investors mitigate this currency risk? Sam, can you shed some light on this?
There are a few strategies. One common method is hedging. This involves using financial instruments like currency forwards or futures to lock in an exchange rate. It's like buying insurance against unfavorable currency movements. However, hedging has costs, and it can also limit potential gains if the exchange rate moves in your favor. Another approach is to diversify across multiple currencies. This doesn't eliminate risk entirely, but it can smooth out the impact of fluctuations.
So, if I understand correctly, diversification spreads the risk across different currencies. So, a strong dollar might hurt returns from European investments, but could be offset by gains from investments in currencies that are weakening against the dollar. This is similar to how diversification across asset classes works, right?
Precisely. And there's another option: investing in internationally focused ETFs or mutual funds that manage currency risk internally. This can be a convenient way for investors who prefer not to actively manage currency exposure.
Those are excellent points, Sam. To recap what we've covered so far, currency risk is a significant factor for international investors. A strong dollar can diminish returns even if the underlying investment performs well, and hedging and diversification are key mitigation strategies. Are there any other approaches investors could consider, Sam?
For longer-term investors, currency fluctuations often balance out over time. So while short-term impacts can be noticeable, the long-term effect may be less pronounced.
Excellent point. So, a long-term perspective can also be a helpful tool in managing currency risk. Before we wrap up this segment, I want to offer a call to action for our listeners. If you invest internationally, explore currency hedging strategies or consider internationally focused ETFs that manage currency risk internally. These are valuable tools that can help protect your investments from the strong dollar dilemma. And that concludes our deep dive into the often overlooked but critically important world of market risk here on Safe, Simple, Sound. We explored the core concepts outlined in the article, Understanding Market Risk, from the different types of risk, like equity, interest rate, currency, and inflation, to practical ways to manage them through diversification, time horizon alignment, and rebalancing. We even tackled some common pitfalls, like trying to time the market and over diversification. I think the scenarios we discussed around rising interest rates and their impact on both bonds and dividend paying stocks were particularly eye opening, offering tangible examples of how these market forces can play out in your portfolio. And of course, the discussion on rebalancing after a bull market offered a timely reminder of the importance of discipline and sticking to your long-term strategy. Thank you so much for lending us your ears today. We truly appreciate you joining the Safe, Simple, Sound conversation. Be sure to check out the show notes for links to all the resources we mentioned. And while you're there, leave us a review and let us know what resonated with you most. Subscribing to the podcast is the best way to ensure you don't miss our next episode, where we'll be exploring how to align your investments with your values through ESG and impact investing, a topic I'm personally very excited about. Until then, stay informed, stay invested, and stay safe. This is Alex, signing off.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.